This is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And today's blog was titled, "Are You Cognizant of It?" And the play on words here was to take a look at a company like Cognizant Technology Solution, a major outsourcer, which is a spinoff from Dun & Bradstreet Corporation, that has really an enviable record in its 13-year history. As you look at earnings per share here, I want you to notice that earnings have grown from 3 cents a share to 5 cents a share, 8, 10, 15, 24, and so on. This company has consistently grown its earnings at a rate of almost 49% a year. I also want you to notice that the stock price tracked those earnings growth very closely. And the main point of the blog today is that, with the recession, the stock price of Cognizant fell dramatically. It fell from a high of almost $48 a share all the way down to $14 a share, towards the end of last year. And by the way, since then it's recovered now back up to over $34 a share, as the company, as you can see, has continued to generate very good earnings all through this recession. And the point is, stock price drops like this simply cannot be trusted. The company has no debt on the balance sheet, is trading at one of the lowest price to sales ratios it's ever had. Now, the point I'm trying to make is simply this. The fundamentals, which I believe are the most important part of the company, clearly indicate that Cognizant is worth more than the market is currently pricing it at. And you can see it was really worth a lot more than the market was pricing it at, back earlier this year when the stock was trading in the teens. But I want you to take a look here at another period of time, and it's harder to see here because of the size of the scale on this chart here. There was another time when Cognizant stock price fell by almost 50% or more back when we had the last recession. And I think if we take a look at that historically, we'll get a very interesting perspective. Now, here's what happened the last time we were in a recession. Cognizant Technology, as it has this time, has continued to generate good earnings. But here's the point I'm talking about. The stock fell from a split-adjusted price of $3.68 in July of 2001, which was the recession year, down to $1.86. That's approximately a 50% drop. But the fundamentals dictated that it was worth a lot more. And I want you to notice that the price rallied dramatically. So even from its fair value price of $3.68, shareholders would have done very well as the stock price rallied to almost $6 a share by November of 2002 and ultimately $11. But obviously those who had the foresight to recognize that this was an undervalued situation here and who were buying the stock during this low period here obviously stood to profit a lot greater. So my point here is real simple. When if as a shareholder of Cognizant Technologies, if you saw the price drop like this and knew that the company was still doing well, rather than panic and sell like a lot of people do, the smart thing to do would be adding more Cognizant at these low prices, because with no debt in the balance sheet and strong operating cash flows, this company was really on sale. I thought it'd be interesting to take a look at operating cash flows. You can see that this company's operating cash flow has actually been higher than its earnings per share. This company generates great cash, trades at a low price-to-sales ratio, has no debt on the balance sheet, and the market was pricing it like it was going out of business. Now, to kind of conclude this, even at the extreme low valuation from its June 30th, 1998 public, offering, a $100,000 investment in Cognizant would have grown to $6,918,000. That's a 46% compounded annual rate of return, versus in that same time frame, putting $100,000 in the S&P would have seen it shrink to $88,000, or a minus 1.1% compounded rate of return. Obviously, it's not about the stock market in this case, and it's not about what the economy was doing. What it's really about is how well the company itself did. If you know the value of your companies, as I say in the blog, the stock market, you'll be able to keep the stock market from exploiting you. This is Chuck Carnevale saying thanks for listening. Hope you enjoyed it. We'll talk to you again next time.